How to assess your investment risk capacity. Have you ever wondered how to figure out how much risk you can handle when investing? Understanding your investment risk capacity is essential for long-term financial growth. It helps you make informed decisions that align with your financial goals. Let's break it down step by step. Investment risk capacity is about your financial ability to handle potential losses in your investment portfolio. This assessment is especially important for Asian families who often juggle saving for education, managing family obligations, and budgeting for celebrations like Lunar New Year. First, think about your time horizon. This is the period you plan to keep your money invested before you need to access it. For instance, if you are saving for your child's university education, which is 10 to 15 years away, you have a longer time horizon. This allows you to consider higher risk investments since you can recover from market fluctuations over time. On the other hand, if you need the funds sooner, your risk capacity decreases because significant short-term losses could impact your financial plans. Next, evaluate the size and stability of your investment portfolio. Consider how much you currently have saved and whether you plan to contribute more in the future. If you have a solid amount saved and expect to add regularly, your risk capacity is higher. This is particularly relevant for ongoing savings for education or family needs. However, if your portfolio is small or you anticipate needing to withdraw funds soon for family expenses or celebrations, your risk capacity is lower. Income stability is another key factor. Many Asian families support extended family members and have cultural expectations regarding financial support. If your income is steady and you have an emergency fund, your risk capacity improves. But if you face ongoing obligations or uncertain income, your risk capacity decreases. Liquidity needs also play a role. This refers to how quickly and how much money you might need to access. If you expect large expenses, such as education fees or festival spending, you should keep some of your investments in safer, more liquid assets. This will lower your overall risk capacity for long-term investments. To get a clearer picture of your risk capacity, consider using risk capacity assessments. These assessments combine financial data like cash flow, net worth, and future commitments. Remember, risk capacity is different from risk tolerance. While risk tolerance measures your emotional willingness to take risks, risk capacity focuses on what your finances can handle without jeopardizing your goals. 4 practical steps. Start by mapping out your major financial goals and their timelines. This could include education, family support, and celebrations. Next, calculate your current savings and expected future contributions. List your fixed and variable expenses, including cultural obligations. Finally, consider your income stability and the size of your emergency fund. By understanding your risk capacity, you can choose an investment strategy that balances growth potential with protection against losses. This ensures you can meet both long-term goals, like funding education, and short-term family commitments, like celebrating Lunar New Year, without added stress.